Pakistan has tapped international capital markets 15 times through sovereign bonds, and 9 of those bonds are still outstanding, adding up to about $6.3 billion plus in foreign currency debt due between 2026 and 2051. The pressure starts building very soon. Around $1.38 billion in principal and interest maturity due in 2026, followed by roughly $1.6 billion in 2027. These payments have to be made in US dollars, which means the burden lands directly on Pakistan's foreign exchange reserves. The real concern is not just how much is owed, but how expensive this money is, because Pakistan is seen as a risky borrower. Investors demand high fixed interest rates, often between 5.8% and 7%, or even more. These rates don't adjust if the economy slows down or if the country faces a shock. The payments stay high no matter what. This locks Pakistan into costly obligations for years, leaving less room in the budget for development, social spending, and economic support. Borrowing more on similar terms could deepen the strain instead of easing it. In contrast, loans from friendly governments or multilateral institutions usually come with lower interest rates, longer repayment periods, and more flexibility in hard times. The deeper issue with sovereign bonds is that they are rigid promises made in an unpredictable world. Pakistan's ability to repay depends on exports, remittances, growth, and a stable exchange rate. But these factors are often outside full government control. If exports fall, global conditions worsen, or the rupee loses value, the cost of repaying dollar debt jumps. Suddenly, the same dollar payment requires many more rupees. Even without borrowing anything new, the debt burden can feel heavier simply because the currency has weakened. There's also a big difference between borrowing from institutions and borrowing from markets. When Pakistan issues bonds, it is not dealing with 1 or 2 lenders. It is borrowing from hundreds of private investors across the world. If trouble comes and the country needs to delay or restructure payments, negotiations become complex. Some investors may cooperate, but others may refuse and take legal action to demand full repayment. These disputes often take place in foreign courts under foreign law, turning a financial problem into a long and expensive legal battle. Bond contracts can quietly add to the pressure. Clauses like cross-default can turn one missed payment into defaults on other bonds. Negative pledge clauses can limit the government's ability to offer security to new lenders in an emergency. Legal provisions allowing lawsuits abroad reduce room for political negotiation and increase the risk of court-driven outcomes. All of this shrinks policy flexibility just when the country most needs breathing space. History shows how these legal and financial tools can be used in tough ways. Russia once held a Ukrainian bond that allowed early repayment if Ukraine's debt rose above a set share of its economy, and when crisis pushed that ratio up. Moscow demanded payment, turning economic distress into legal leverage. In Argentina's long debt saga, holdout investors use standard bond language to sue in foreign courts and block payments to other creditors, trapping the country in years of litigation. Sri Lanka's recent crisis showed how multiple bond contracts, cross-default rules, and scattered investors can make restructuring slow and painful even after a country stops paying. Another challenge is that bonds are tradable. Investors can buy and sell them every day. If confidence in Pakistan falls, bond prices drop and interest rates rise, making new borrowing even more expensive. Global events far beyond Pakistan's control can quickly change market mood. This means borrowing costs can spike at exactly the wrong time. Bonds are not automatically bad. They can help diversify funding sources and signal access to global markets. But for a country with limited reserves and frequent external pressures, heavy reliance on high-cost foreign currency bonds carries serious risks. Careful borrowing, stronger economic fundamentals, and greater use of concessional and bilateral financing can help ensure that today's funding needs do not turn into tomorrow's crisis.